In 2017, a 25-year-old MIT physics graduate named Sam Bankman-Fried sat in a Berkeley apartment staring at Bitcoin price feeds. Japan's exchanges listed the coin $300 higher than US venues. Sam smelled risk-free profit. He borrowed millions, shuttling coins through sleepy banking rails, and in 4 weeks pocketed double-digit returns. The stunt birthed Alameda Research, a prop trading desk run on caffeinated math and utilitarian philosophy. Get rich, give it away. Inside a Hong Kong office laced with beanbags and sleeping bags, 20-something quants coded between League of Legends matches, extracting basis spreads from Seoul to Santiago. Sam's frizzy hair and cargo shorts disguised a ferocious appetite. Larger trades, faster wires, deeper liquidity. When traditional brokers called crypto Tulips 2.0, he answered with limit orders that never slept. By 2019, Alameda was moving $1 billion a day, and Sam realized the real jackpot wasn't trading on exchanges, it was running one. Launching in May 2019, FTX advertised itself as the Engineered by Traders Exchange. Cross-margining, tokenized stocks, 101 times leverage, Ferrari features in a Corolla market. Sam lured liquidity with maker rebates and gave venture funds equity at fire sale valuations if they parked assets on platform. Fees poured in. FTX bought Super Bowl ads before Coinbase could draft a script. In selfies with G7 ministers, Sam preached effective altruism, promising to donate his fortune to pandemic defense and climate tech. He became the de facto Washington voice of crypto, briefing senators and SOCs and warning them about unsafe rivals like Binance. Behind his backroom grin stood an opaque web. FTX customer deposits quietly routed to Alameda through a secret allow negative code line. The house was printing chips and sliding them to its own high roller table. No pit boss, no audit. By January 2022, FTX was valued at $32 billion, more than Nasdaq's parent company. Miami's NBA arena swapped its name for Sam's. Tom Brady threw laser-eyed passes in primetime commercials. A Canadian teacher bought FTT tokens for her retirement, trusting the exchange's safest balance sheet in crypto. Venture firms stamped term sheets in 24 hours, skipping due diligence for fear of missing the next Amazon. FTX hired an ex-CFTC chair as compliance chief, sponsored esports leagues, and opened an office in the Bahamas painted Millennium Blue. Inside, executives shared a luxury penthouse, where Slack channels crossed into polyamorous diary entries. Yet number go up masked cash flow truths. Market-making losses at Alameda, ballooning loans collateralized by its own FTT token, and a balance sheet that would shatter if crypto prices fell 20%. The music kept playing because everyone wore noise-canceling headsets of greed. On the 2nd of November 2022, a CoinDesk journalist published Alameda's leaked balance sheet. $14 billion in assets, half of them FTT, a token printed by its sister exchange. Binance CEO Changpeng Zhao tweeted he would liquidate $500 million of FTT due to recent revelations. Crypto Twitter smelled blood. Withdrawals spiked from $80 million to $6 billion in 72 hours. Sam reassured users with lowercase tweets, assets are fine, while compliance teams watched hot wallet gauges sink like mercury in winter. Without customer cash, Alameda's margin calls hit. It repaid loans by yanking deposits from FTX until both entities circled a drain of their own making. On 8 November, Sam DM'd CZ a plea for help. Binance signed a non-binding bailout letter, then walked after 24 hours of rudimentary books. Screenshots of negative balances leaked. Hidden, poorly internally labeled. The world learned that a digital bank run travels at fiber optic speed. November 11, 2022. FTX, FTX US, and Alameda filed Chapter 11. New CEO John J. Ray III, famed liquidator of Enron, described a complete failure of corporate controls. Slack approvals for billion-dollar loans were confirmed with emoji. Accounting ran on QuickBooks tagged ? Sam resigned in a Google Doc from his Bahamian penthouse, the ocean view now backdrop for FBI wiretaps. For 9 million customers, account dashboards froze on balances they might never see again. Pension funds wrote down investments to zero. Solana's ecosystem lost half its total value overnight. The whole, $8.9 billion, enough to fund NASA's Artemis lunar lander. Crypto markets shed $180 billion in a week, proving that however decentralized coins are, trust in exchanges remains painfully centralized. On December 2022, Bahamian police escorted a barefoot Sam Bankman-Fried from his apartment. Extradition papers cited wire fraud and money laundering conspiracies. In court, he blamed poor risk management, echoing Icarus complaining about wax quality. Former Lieutenants Caroline Ellison and Gary Wang flipped, revealing God mode backdoors that let Alameda drain customer funds. The October 2023 jury deliberated 5 hours before a guilty verdict on 7 counts. Sentencing day, 28 March 2024. Survivors packed the gallery as Judge Kaplan declared, 25 years in federal prison and $11 billion forfeiture. Sam stared forward, curly hair trimmed but hubris intact. Outside, a protester held a sign, "Not your keys, not your coins." FTX's crater jolted governments into action. The EU fast-tracked MiCA, imposing reserve audits and board-level liability on crypto firms. US senators unveiled the Digital Commodity Exchange Act, requiring segregation of customer assets and real-time proof of reserves. Big Four auditors launched blockchain nodal attestation services. Exchanges scrambled to publish Merkle tree snapshots of wallets. Venture capital rewrote term sheets. No related party lending. Independent board seats mandatory. Meanwhile, decentralized protocols like Uniswap and Aave reported record volumes. Code, after all, can't funnel deposits into penthouses. The pendulum swung from cults of personality to transparency you can query at 0xF0 in a block explorer. Spring 2025. Bankruptcy teams have clawed back 70% of missing assets through Bahamian liquidations and token recoveries. Victims may receive partial payouts in stablecoins. A Miami teacher checks her wallet. Fraction restored. Trust not so much. Crypto conferences now begin with a moment of silence for exchanges gone dark. Yet innovation persists. Zero-knowledge audits, multi-sig governance, and on-chain circuit breakers inspired directly by the FTX postmortem. In a Stanford ethics class, slides compare Bankman-Fried's effective altruism rhetoric to the reality of misused funds, debating whether ends can ever excuse opaque means. The consensus: transparency is cheaper than charisma, and blockchains remember longer than marketing slogans. On a hardware wallet cold as metal truth, a user engraves a reminder, proof over promises. The engraving might not go viral, but the lesson just might.